Of the world's richest individuals tracked by the index, only Mark Zuckerberg, Chanpeng Zhao, and Elon Musk have taken a larger hit, though that could change following Amazon's prediction of weak holiday sales, sending shares plummeting in after-hours trading. In this video, I've brought to you the news in detail. Make sure you stick with me to the end of the video so you don't miss any part of it. Without any further delay, let's get into it. Jeff Bezos on brink of wealth drop, among worst on record. Jeff Bezos is set to see as much as $23 billion erased from his fortune after Amazon projected sluggish sales for the holiday shopping season, sending shares plunging in after-hours trading. The stock fell as much as 21% after the market closed Thursday. If that drop carries into Friday's session, the Amazon founder's wipeout would be the fifth largest one-day decline in wealth on record, according to the Bloomberg Billionaires Index. Should the move hold, Bezos would be worth about $111 billion, according to the Bloomberg Wealth Index, about half as much as his $214 billion peak in July 2021. His wealth tumbled by more than $58 billion this year as of Thursday's close, as a broader slump in technology stocks has weighed on Amazon. The world's largest retailer's forecast for the final quarter of the year fell far short of analysts' estimates, and Amazon expects the effects of inflation, rising fuel costs, and weaker demand to persist. The online retailer has also been reeling from the customer pullback from e-commerce as shoppers return to their pre-pandemic habits. The company's stock is down about 33% this year through Thursday's close. Bezos holds about 996 million shares in Amazon, according to an August filing. Mackenzie Scott, who separated from Bezos in 2019, is set to lose $7 billion from her net worth, which was $26.8 billion as of Thursday's close. She holds more than 293 million shares of Amazon, based on an analysis of the company's 2022 proxy statement. Next up, let's look into deflated expectations for Amazon in the post-Jeff Bezos era. Rising costs, disappointing Prime sales, and inflation are leading some analysts to temper their projections ahead of the e-commerce giant's Q3 report. This may be what Day 2 at Amazon looks like. Several analysts on Monday lowered their sales, profit, and other targets ahead of the e-commerce giant's third quarter earnings report Thursday, citing its rising expenses, disappointing Prime Day sales events, and a tough macro environment marked by inflation. The company joins them in taking a more conservative approach to its own guidance, according to a Monday research note from MKM Partners Managing Director Rohit Kulkarni. That could be part of a wider shift in retail strategy under CEO Andy Jassy, who took over from founder Jeff Bezos last year, according to Shlomo Chop, managing partner at real estate advisory firm Case Property Services. Chop said by phone that he thinks Jeff Bezos is more of a founder or visionary, and Andy Jassy is more of an operations guy, and there's a difference between the two. Telsey Advisory Group on Monday lowered its expectations for Amazon sales and profits in both the third and fourth quarters, citing softer macro trends in the U.S. and international markets, the tighter consumer spending environment, and the lower than anticipated response to Prime Day 2022. Those analysts, led by Joseph Feldman, expect that Amazon's Q3 sales will benefit from the first Prime Day sales, which was held in July, but less than the 400 basis points of growth they previously anticipated. Research showed that, defending against inflation, many Prime Day shoppers stuck to buying essentials. The average order size during the second Prime sales event held earlier this month was down 23% from the July event, according to Numerator. Feldman said their sense is the Prime Early Access sale was lackluster as well, with discretionary spending down as consumers spend more due to inflation and prioritize services like entertainment and dining out. Amazon is exposed, according to Wells Fargo analysts led by Brian Fitzgerald, citing declines in electronics sales and weakness in apparel and accessories. The company is leaning more heavily on non-retail operations to make money. MKM analysts said their communications with Amazon Marketplace sellers lead them to believe that the Prime sales in October were below those in July, but that ad spend on Amazon has stayed above industry trendline. The firm is lowering its e-commerce and Amazon Marketplace assumptions while keeping its AWS subscriptions and advertising estimates unchanged. This is another shift from the Bezos era, when the customer was an obsession, according to Chop. For Jeff Bezos, his whole thing was customer first, he said. Chop added that if you're advertising, you're not giving people exactly what they're looking for, but trying to push them somewhere else. If you're giving people only what they're looking for, what's the point of advertising? Amazon is also facing exploding costs. These costs stem from hiring and wage increases, including 150,000 announced ahead of the holidays, which could add $1 billion to its costs next year. Higher stock-based compensation that likely adds as much as $4 billion this year in incremental deleverage in 2022, and potential costs from its fights against unions, according to MKM Partners. Despite the new pressures and possibly the new approach, Amazon remains in a good position longer term, analysts said. Telsey's Feldman said that Amazon Amazon's profitability is likely to be pressured from elevated promotions across retail, inflated operating costs, including labor, supply chain, and last-mile delivery, and ongoing strategic investments. He added that beyond these trends, we still expect Amazon to outperform the broader retail market, given ongoing market share gains from leveraging its sticky customer base and small business relationships. Is Amazon inevitable? What does the future hold for this very diversified and very controversial online titan of commerce today? Amazon has been on a historic run. In the annals of business history, there have been few, if any, companies that have ever grown as fast and as vast as Amazon has under Jeff Bezos. From an innovative model to simply sell books online to becoming a diversified, innovative company across many lines of business, the Amazon story has been a remarkable one, producing amazing returns for its shareholders, especially over the past 5 years. Amazon has achieved what consumer-facing companies dream of. They've become indispensable, and some would say, to borrow from Thanos, inevitable. The era of the coronavirus showed just how much Amazon has become a part of many of our lives on almost a daily, and in some cases, hourly basis, with its panoply of services and platforms. Taken as a whole, Amazon has seemingly done all the right moves to position itself as a first choice for consumers today for just about everything, becoming, yes, inevitable as a destination for both companies and consumers to meet today. From an analyst's perspective, then, the company seems to achieve a superior competitive position at present, with its only real competitor with the stature and reach to challenge its dominant market position being Walmart. And while Walmart has certainly made massive investments to improve its online capabilities and has proven to be almost as agile a big company competitor as Amazon could ever likely have, they do seem to be more reactive to Amazon's competitive moves in terms of their own strategic initiatives. I mean, think of their move into subscription services. Walmart is and will remain a strong competitor to Amazon, and it will likely continue to be dominant in the physical world of retailing, especially as both major chains and small retailers alike continue to struggle even for existence today, a struggle only exacerbated by the pandemic and the economic challenges it has brought on for all of us. However, what we're increasingly seeing is a two-track retail environment, one where Amazon is expanding on its dominance in cyberspace and Walmart is building upon its success in physical retailing, but with increasing cross-competition between the two behemoths in each other's principal space. Still, just as Walmart has ambitious goals to grow online, and Amazon grows in physical retail, neither company really has the ambition or really even the resources even for them to overtake the other in their home environment, at least not within the next decade or more. So, what are the real strategic threats to Amazon at present? Immediately, one would say that the threats the company faces are mostly due to its size, meaning that its threats are largely a product of Amazon's success. History has time and time again shown that when companies grow so fast and so vast, they become more and more difficult to manage. Think of the travails of the big auto companies, not just in the United States, but globally as well. Today, with vastly improved corporate management, systems and data analytics, one could presume that Amazon could avoid or at least mitigate many of the problems attendant with managing an enterprise of such size. However, just as it's more difficult to maneuver any large vehicle over a small one, I mean a motorhome versus a car, or a supertanker versus a small watercraft, changing the course of a large company has historically proven difficult at best and impossible in many cases with the organizational inertia that these sizable enterprises create. If and how Amazon can do so will be a critical stress test and a crucial success factor going forward. That's all we have for this video. Thanks for watching. If you like what you see, please give us a thumbs up. Don't forget to subscribe to see more videos like this, and we'll see you next time.